What comes after earnings? Let's take a look. Do stocks go the way of earnings or do they go the other way?
Uh, I believe after earnings, I believe they trend sideways for the most part. I mean, I think depending on again, I haven't seen this. The study set, I would say it was sideways to higher just because we're at all-time highs, Sosnoff.
So the question is, if you have an earnings report that's in line, obviously afterwards the market's probably going to do, the same as it was doing before. But if you have a
Uh-huh.
stock that has a really good earnings report or a really bad earnings report, do you think the market continues to trend in the direction that it went, or do you think that it all normalizes and just becomes random again?
In a 45-day time frame after the trade is made, I got to say it's all random. Immediately following, I would say it kind of stays in the direction it's in. I don't know if I'm
Um,
answering. I don't know if I'm answering to the study.
let's take a very good, let's take a good hard look at this because it's really interesting. And some of the results are a little different than you might think. Publicly
Awesome.
traded companies release quarterly earnings reports detailing their financial performance. These reports come out either before the market opens or after the market closes. The overnight moves accompanying these releases are often dramatic. Because this is anticipated, implied volatility is typically elevated just before earnings and falls off after. We've explored placing earnings trades before, but whether you have an earnings position still on or you're considering trading an underlying now that the dust is settled, what happens to the underlyings in the weeks following an earnings report? This is an important question for retail traders. Let's take a look. This is the first kind of study we've done exactly on like this topic. Next slide, please, John. So we examined each earnings announcement from the 15 largest components of the S&P 500 for the past 8 years. So it's a massive study. For each, we looked at the overnight's earnings move and the 7-day move and then the 30-day move, close to close, following the earnings move. So we looked at overnight, 7-day, 30-day, all right?
All right,
A
I'm interested
correlation
here.
from -1 to +1 between the size of the earnings moves and the size of the following moves. How frequently the following move was the same direction as the earnings move. We call that continuation. The average size of the 7 and 30-day moves, meaning the mean absolute. So we contrasted the overall statistics of those following earnings moves that did or did not exceed the implied move. And we just put a little caveat at the bottom, says, note that these earnings moves only stayed inside expected 48% of the time, far below theoretical or the empirical non-earnings frequencies.
Yeah. Okay.
Let's go to the next slide. So what comes after earnings? So the first one we looked at was overall, okay? So the correlation, the continuation, and the mean absolute move. So this is interesting because you know how sometimes we go, well, it's only got priced in a 3% move and stuff like this. And remember, this is the top 15 stocks over 8 years in the S&P 500. So when we look at the overall, the size correlation and the continuation, the first thing that pops up here is that, you know what, these moves tend to be a little greater than whatever the expectation is right around earnings, because those are higher numbers, the mean absolute move, and the continuation number is a little higher than a random number would be. Yeah, I mean, they're a little bit higher. So the size correlation is also interesting in saying that after 7 days, there's some correlation. After 30 days, there's a little less correlation, but the continuation of the move is pretty good. So on this slide, this is with earnings inside the expected move. Now, of course, if it's inside the expected move, the correlation is going to be lower and the continuation is going to be lower. And then the mean absolute move after 7 days is obviously smaller and after 30 days is smaller. So when they're inside the expected move, I would say this is pretty random. 52%, that's probably in line with just a completely random number. So if the earnings are inside the expected move, then there's not that much to actually consider, right? About a continuation or stuff like that.
Yeah, 100%.
Let's go to the next slide, John. This is earnings outside of the expected move. Well, here, everything changes. And you can look at the size correlation, you can look at the continuation numbers, and you can look at the size of the mean absolute move. And what happens for earnings moves outside of the expected move is that there tends to be a very high continuation move after the number comes out. So if you have a really bad earnings report, there tends to be, 8 out of 10 times the stock continues to go lower after 7 days, and 7 out of 10 times after 30 days. And this is in the top 15 stocks in the S&P 500. And if it's and I think those numbers do have a lot of value to them.
Agreed. I do. I think they do
And
too.
the mean absolute move is usually greater than you think it's going to be.
So it means you got to be a little bit aggressive, especially if you're looking to roll up the untested side or do anything like that. I mean, that's my takeaway.
I think that's fair. Yeah, this is a very powerful slide that we haven't done before.
And it's funny because if I think back about emails that I get for earnings, if a stock moves, let's say, outside the expected move to the downside, even though the market's a little bit, bid the way it is right now at market highs, people sit for a couple of days because they think it's going to correlate with the market or come back a little bit. Most of the time, it is like, what do I do now? I didn't roll, that kind of thing. So I think being aggressive with your rolling is probably my biggest takeaway for this.
Okay.
Earnings.
Bigger numbers than I thought, way bigger. I thought there'd be a little bit of positive, outlier moves would have a little bit of positive continuation, but not from 50-50 to 8 out of 10. When earnings moves felt within the expectation, the underlying afterwards performed like the underlyings any other time. That's exactly that was our takeaway. The following unexpected large earning moves, however, we saw the underlyings making large moves very frequently, continuing in the direction of earnings, like 70 to 80% of the time. These moves might well be anticipated and priced into the premiums available post earnings, but understanding what is typical following earnings can help you choose how to play it. Yes, it definitely is going to influence and impact our decisions somewhat. So very good, Mark.